REITs, real estate investment trusts, are the third kind of alternative investments that have made a big breakthrough across asset portfolios in the millennial categories. This includes hedge funds, venture capital funds, private equity, and this is REITs. Let's learn more about real estate investment trust in this section. REITs own or operate or finance real estate. So many investors who don't want to put in a large amount of capital into a single asset class, they would rather put it into REITs because, like mutual funds, which achieve diversification through investing in a variety of stocks, REITs also achieve diversification through investment in different kinds of real estate. These could be commercial real estate, residential real estate, in fact, even broadband towers could be an aspect of REITs. REITs today own more than $4.5 trillion worth of real estate only in the United States of America. This is a very significant amount of asset allocation that has taken place, and therefore a lot of REITs, including BlackRock, etc., have started outsourcing accounting and administration to their operations in India and other centers of the world. REITs own more than 550,000 properties in the United States, amounting to trillions of dollars, making it amongst the largest asset classes in the investor's portfolio. The shareholders. So, how is the REIT structured? Shareholders contribute capital to the REIT. So, the REIT is structured like an asset management company, which has a fund manager, it has a research team, it has an analytics team, it has an investing team, it has an administration team, HR, etc. So REIT collects capital from all different kinds of shareholders and then pools in this capital. Now, what do they do with this pooled capital? The REITs invest these pooled capital into real estate. Now, what kind of real estate is clearly mentioned in the offer document, whether it's commercial real estate, residential real estate, whether it's internet towers, broadband towers, whether it's medical hospitals, etc. Any of them could be a category of real estate. So don't think of real estate only as land and building. It could be any of these assets where the property acquisition is financed by the REIT and the operations are then run by the company itself. The real estate shareholders therefore invest in the REITs. The REITs pool in the capital from different investors and different shareholders, and they make investments into real estate. So, real estate diversification, real estate maximization of returns, etc., is achieved very smartly through the REITs. Real estate generates income. Okay, so the definition of an REIT as per SEC is that REITs invest in income generating real estate. This income is then given back to the REIT. Okay, so the REIT makes investments in the real estate generates income by way of rentals. If it's an equity real estate investment trust, if it's a mortgage real estate investment trust, it generates interest income. The REITs collectively aggregate this income and distribute it back to the shareholders by way of dividends. So the operating structure is similar to a mutual fund or to a hedge fund, and the flow of income on recognition of income also is something like this. If I look at the SEC website, I got this structure. Let's look at step 1. The REIT manager submits the application for sale of trust certificates to the SEC. SEC, as you already know, is the Securities Exchange Commission of the United States of America. As a part of step 2, a REIT manager must offer the sale of units to different unit holders. What I referred to as shareholders in the previous 2 slides is called as unit holders. Step 3 is the fund is transferred for subscription account to the underwriter. As you already know, underwriter is an entity which underwrites the subscription of investment. The money that's collected by the underwriter is then transferred to the trust. Every REIT must have a trustee. That's the name itself, right? Real Estate Investment Trust. So every trust must have a trustee. The trustee then supervises the REIT's performance and the fund manager's performance. So the main reason of establishing a trust is to ensure that the unit holder's interest is protected. Step 6, the REIT makes an investment in real estate. Step 7, the real estate generates rental income. And step 8, finally, the distribution of benefits from the trust go back to the REITs. So this is a very simplistic structure of an REIT. If you look at other kinds of REITs like mortgage REITs, there may be an additional step in terms of financing of the asset acquisition. The structure of the REIT could be of two types. Largely, they are of two types across the world: equity REITs and mortgage REITs. Equity REITs are REITs that lease the property and earn rental income. So the real estate investment trust owns the property. After acquisition of the property, they lease it to earn rental income. The kind of properties could be commercial properties, residential properties, or even specialty properties. So commercial properties are those properties that could be used as offices, warehouses, amongst others. Residential properties include those that are invested for residential purposes. Specialty could be something which is very focused, for example, only in medical hospitals or only in towers and so on. Towers, by towers, I mean broadband towers. They purchase the real estate, they lease the property, and they earn rental income. The equity REITs, by earning rental income, they have to manage their real estate investment trust expenses from this income. Therefore, they must pay 90% of the income to the shareholders. By shareholders over here, I mean unit holders. Okay? Now, this is a mandatory aspect of REITs. The SEC has mandated that 90% of all rental income earned by the REITs must be distributed to the unit holders. This is compulsory, this is mandatory from the SEC point of view. For example, I decided to beef up my presentations, my videos with a little bit of examples so that we understand how the theory meets practice. Is this a real world that we're talking about? American Tower Corporation is amongst the top 5 bets that many of the research analysts have prescribed for investing in REITs. The American Tower Corporation, as the name suggests, owns and leases broadcast towers. Okay, so they own and lease broadcast towers all across the world, not just in America, but even in Asia Pacific region, as well as in North Africa. It has more than 200,000 towers across the world, and the stock price in NYSE is $225. So REITs also get listed in the New York Stock Exchange or the Nasdaq or any other exchange that they are trading in. On the other hand, mortgage REITs are those that finance the acquisition of real estate. Okay, so they act like finance companies or lending institutions that enable others to acquire real estate. They purchase or they originate mortgages and mortgage-backed securities as financiers. MREITs, this is the short form for mortgage REITs, is called MREITs, earn interest income. Okay, so they act, they operate, they originate, they work very, very similar to a lending institution or to a credit institution. The mortgage REITs borrow capital from different sources. They invest both debt and equity as by capital, and they pay interest on the debt component. Okay, as MREITs earn interest income, they must pay interest on the borrowed capital which they borrowed. They earn a net interest income, the difference between the interest income they've earned less the capital expenses that they have to bear because of the borrowing. So they earn NII, that is a net interest income, which is remarkably similar to what is earned by banks and which is actually a performance parameter for MREITs. As MREITs earn interest income and they pay interest on borrowed capital, they must pay also the dividends, etc., to the shareholders or to the unit holders. Okay. So you understand this? They borrow capital, they use the borrowed capital to invest in real estate, they earn interest income, they pay interest expenditure, and they must also distribute their profits by way of dividends to the unit holders. MREIT's example, we have a very large REIT by the way of Blackstone Mortgage Trust, BXMT, which originates senior loans collateralized by commercial real estate. Almost $20 billion in senior loans are handled by Blackstone Mortgage Trust by financing commercial real estate. If you like the content in this video and if you're interested in a career in fund accounting, corporate actions, trade life cycle, and OTC derivatives, do subscribe to my YouTube channel. Thank you.